Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is my co-anchor Harsh Saita. Now, as promised, we'll move on to news coming in on the domestic front. BPCL is in focus on the back of their 18,000 crore rights issue. Now, why is the street cautious about the state-owned refiners' fundraising plans? Well, my colleague Somit has some data to put into perspective all of that. Take it away, Somit.
Well, if you see, the BPCL board has announced a rights issue of around 18,000 crore rupees. Now, the issue price, entitlement ratio, record date and the timing are yet to be announced, but this rights issue is actually been approved to allow the central government to put in funds in the company, which was already approved in the budget. They had approved around 30,000 crore rupees to be infused in all the three oil marketing companies, and that's the reason this rights issue has been approved by the board. Now, why is this rights issue negative for the company? Because at the current scenario and given the capital expenditure plans of BPCL, they actually did not need this fund infusion coming in from the government. Also, the cash flows are strong for the company, while the leverage ratio continues to remain strong, which means that the street was confident and that the company could easily pay for its capital expenditure plans through internal accruals. Also, this rights issue that the government has, that the board has now approved, will be EPS dilutive. Now, at the current market price, the FY25 EPS dilution could be at around 12%, but generally rights issue happen at a discount, and if you see, if this rights issue goes around with a discount of around 10 to 30%, then the EPS dilution would be in the range of around 14 to 18%, and this is one of the concerns of the street. Also, the street continues to believe that viability gap funding would have been a better route to infuse the funds in the company rather than an equity issue. Now, the other thing that the street is fearing at this moment is, given that the high marketing margin fund infusion was not required, because in this high marketing margin environment, the losses that the company had incurred in FY23 could already be sufficed for, because in FY23 the companies had incurred losses due to unchanged retail fuel prices and high crude prices. But given that the margins are higher at this moment, the losses would have been easily taken care of. But given the fact that government is infusing funds now, will the government actually go ahead and now start cutting fuel prices? And this is one of the bigger concerns on the street. Also, given the fact that the election year is starting now, and the margins that the oil marketing companies are earning are at least 3 times higher than the normalized margins. On petrol, they are earning a margin of around 14 rupees, and on diesel, they are earning a margin of around 9 rupees. And this is the bigger concern that is coming in for the oil marketing companies, including BPCL. So far, BPCL has approved this rights issue. Indian Oil Corporation and HPCL are yet to make any announcement regarding a rights issue.
Right, thanks.